In this week's video, we'll review the latest charts and indicators to help us answer the question, does the tech-heavy NASDAQ look more like a major peak or a once-in-a-lifetime opportunity? Since the vast majority of present-day market participants lived through both the bursting of the dot-com bubble and the financial crisis bear market, if we were posed the question in this week's title slide based on impressions, intuitions, or feelings, if we didn't do any digging, it's pretty easy to understand how we might side with the present day must look more like a bubble than an opportunity. So now that the market's closed, let's dig a little deeper and utilize System 2, which is useful for harder questions. And after we use logic, perform an analysis, and reflect a little bit, can we find information that would help us overturn our impression or off-the-cuff intuitions or feelings about the bubble versus opportunity question? It's important to note there's a big difference between the utility of short-term timing signals and long-term big-picture confirmation signals. The charts that follow are long-term big-picture confirmation signals, which means these time frames and these inputs are not used by the model. The model uses faster time frames and faster inputs. These time frames help us confirm the conclusions that we've already drawn previously based on the model readings looking backwards. Therefore, if you know your market history, this is the NASDAQ quarterly. This looks really complex. We're going to walk through it step by step and basically perform a pattern recognition analysis. We know, based on market history, that the early to mid-1990s was a buying opportunity. After we could see all of this, observe it, really good things happened in the NASDAQ for a long period of time. And since all good things must come to an end, eventually the market needed to consolidate its gains, and it rolled over in a violent manner. Therefore, to help us answer our question, does the present day look more like an opportunity or a major top, we can compare the look of ADX, Bollinger Bandwidth, the Kopic curve, and rate of change. So can we see a discernible difference in black ADX for a buying opportunity relative to a selling opportunity? Well, the answer is yes. Here, black ADX had been falling. It made a bottom and started to rise while it was under green ADX. That really doesn't look anything like this period here. Black ADX is above both green and red, and instead of turning up, it's rolling over. This really doesn't look anything like this. Similar situation in all four cases. Bollinger Bandwidth, buying opportunity. It had been falling. Now it was rising from relatively low levels. That doesn't look anything like the Bollinger Bandwidth up here, where it rolled over from relatively high levels. Kopic curve here had been falling, started to rise from low levels near the buying opportunity period. That doesn't look anything like the Kopic curve up here that's well above 300 and then rolls over. Similar situation for rate of change. It dropped below zero, made its way back above, kind of hung around the zero line here at the buying opportunity point. That doesn't look anything like this extended look where rate of change is above 250, rolls over, and plummets. Since we've just shown that the indicators near the major peak look strikingly different relative to the look of the indicators at the buying opportunity, if the present day facts are going to support the intuitive bearish conclusion, we would expect the present day to look a lot more like this period here relative to the look of this period here. So let's fast forward to the present day and let's add some horizontal lines. Present day level of black ADX. If I draw a horizontal line I'm similar to the look of black ADX near the buying opportunity. Bollinger Bandwidth, present day level, similar to the level at the buying opportunity. The Copic curve, present day Copic curve is here. Draw my line, looks very, very similar to the Copic curve at the buying opportunity. Rate of change at the bottom. Here's my rate of change in the present day. If I go backwards to the buying opportunity, I'm hitting the black line. In every case, I hit these lines somewhere. Hard to say that the levels don't look similar. And the levels that look similar appeared at what turned out to be a wonderful buying opportunity in the NASDAQ. Let's contrast the look of the present day relative to this period to the look of the indicators near the major peak. So what we've done here, here's your major peak. We've drawn a horizontal line from the level of ADX, Bollinger Bandwidth, Copic curve, and rate of change so we compare it to the present day. And we know the look here came before really bad things happened. And in each case, for each indicator, the present day really doesn't look anything like the levels that we found near the major peak. There's a huge gap between the level of black ADX in the present day and the elevated level here. Same can be said for Bollinger Bandwidth, the Copic curve, and rate of change. Now let's talk a little bit about what the indicators tell us. When ADX is at high levels and falls to relatively low levels and turns up, typically that's telling us that a new trend is starting. It doesn't tell us whether the trend is bullish or bearish necessarily. That's where the green and red lines come in. Typically, when black ADX troughs from lower levels looking backwards and green is above red, that tells us a new bullish trend is starting. If you know ADX, when black ADX gets above both green and red, as it was at the peak in 2000, that's an extended vulnerable market. And when it rolls over from extended levels, it's telling us that this bullish trend might be ending, that we should be on higher alert. So knowing what we just said about ADX, look at the present day. Black ADX is at very low levels in 2011 if we look backwards relative to this level here. In fact, it's below both green and red. This is indicative of our trendless, sleepy market. This is a sleepy market on a relative basis. This is an overextended market. This is a good entry point here. And this also represents a relatively good entry point as well. This really doesn't look anything like this here. Our level is much, much lower, and the last thing that happened was ADX turned up. ADX turned up. The last thing that happened here is it turned down. Very, very similar situation for Bollinger Bandwidth. This is our sleepy, trendless market. After that, good things happen for a long period of time. This is our sleepy, trendless market. When we look backwards, these levels are low relative to these levels here. This level is low relative to these levels looking backwards. This is our sleepy, trendless market. This is our sleepy, trendless market. This is our overextended market. The present day looks a lot more like this period here than this period here for Bollinger Bandwidth. Similar situation for the Copic curve. It had been falling, started to rise from low levels here near the zero line. Here had been falling, started to rise from low levels near the zero line. What we just described doesn't look anything like this peak. We're nowhere near the zero line when the market peaks in the year 2000. We're at very, very high levels and we roll over. Same can be said for rate of change. We dropped below zero and we started to rise in the buying opportunity. We dropped below zero, we started to rise. We're near zero, started to rise. Compare and contrast the look here and the look here to the look here. We're majorly extended. We're nowhere near the zero line here. This is an overheated market. This really doesn't look anything like this, and this really doesn't look anything like this. And as these horizontal lines showed, the present day does look a lot like the opportunistic period here. It really doesn't look anything like the overheated look before the NASDAQ bubble popped. Why is all of this relevant? Because the move after we could see these setups here was substantial. From this point here, the market rallied for an additional 7 years and tacked on an additional 645% in the NASDAQ Composite Index. Contrast that from peak to trough, the NASDAQ lost 78%. Thus, your goal here is not to avoid the entire 78% loss. That's not realistic. That's picking a top. You want to try to mitigate the damage using the observable evidence. So what's the moral of the story? The moral of the story is the look of these indicators in the present day as of June 21st, 2018 are telling us to keep an open mind about better than expected outcomes occurring for a long period of time. And as always, that is not a forecast. It is a probabilistic statement based on the facts that we have in hand today. If the facts change, then we will reassess the probabilities. Some quick points relative to our question. Let's think about what the question was. First of all, it was a question. Does the NASDAQ look more like a major peak or a once-in-a-lifetime opportunity? Based on the setups in the present day and these setups and the gains that occurred after these setups, and the fact that the present day really doesn't look anything like these setups here, where the bear market inflicted a 78% loss on investors, it's pretty fair to say, since the question is, does the NASDAQ look more like? It looks more like the opportunity. And we're only asking a question. We're not making any definitive statements about anything. We're simply answering this question. And it's not a stretch to say, based on the facts that we have in front of us today, the present day looks more like the opportunity period relative to the major peak. And it can't be emphasized enough. We're making probabilistic statements based on the facts in hand as of 6/21/2018. Regardless of the look of this chart or any other chart, the probability of a major peak is never zero. These are not binary questions. We're assessing probabilities related to an uncertain future. All of this helps us with the probability of good things happening looking forward relative to the probability of bad things happening. The term probability tells us, number one, we're not forecasting, we can't predict the future. And number two, the possible outcome list includes favorable outcomes and unfavorable outcomes. Regardless of any of the charts that we have covered in this video, it's extremely important that we take it day by day and maintain that maximum flexibility about what these charts might look like in the future. There's nothing wrong with confidently assessing the hard data in front of us and assigning probabilities to outcomes, understanding that the future is uncertain. The flexibility comes in relative to we have no idea what these indicators and what this chart will look like in the next 3 days, 3 weeks, 3 months, or 3 years. And that's why we have to continue to collect the latest data, run the model, and ask the question, based on the facts that we have in hand, are we allocated properly? If the answer is yes, leave it alone. If the answer is no, make an incremental adjustment to get back in line. And we simply repeat that process over and over again with a flexible, unbiased, and open mind, which is our way of saying we are not predicting, we are assessing. And fundamentally, Ryan Dietrich's tweet from June 21st seems to align with the conclusion we're drawing from a probability perspective using the charts. His tweet basically says leading economic indicators, the facts that we have in hand today, are nowhere near any recession-type levels yet. So we can take a weight of the evidence approach. Let's look at the same quarterly chart for the NASDAQ Composite Index. This time we'll move in a little closer. This is 1993. This is 2018 here. Now we're looking at quarterly Williams percent R, True Strength Index, the full stochastic oscillator, and RSI, or the Relative Strength Index. And we're asking one question and one question only here. Does the present day look anything like the major peak in 2000 and or the major peak in 2007? So these are the looks we want to avoid. Williams percent R looking backwards for the most part stays above -20. Here, this looks different. We're making a lower low that we've never made looking backwards. Similar situation here. We're up high, we break out and make a lower low. TSI, the peak in 2000, we get a bearish cross, black goes below red. Similar situation here, 2008, we get that cross, we get that turn down look here. Remember, these are confirmation signals. We're not using these as timing signals. Full stochastic, it's up high. This looks different than this, and this looks different than this. Similar situation with RSI. This, in the year 2000, looks different than anything looking backwards here. This looks weak. It wasn't even able to clear 70, and then it starts to fall and drops below 50. We don't have any of that in the present day. Williams percent R clearly still above -20 on June 21st, 2018. TSI has a bullish look. We are not even close to getting a bearish moving average crossover. Full stochastic drops out, still above 80 here. This looks a lot more like this than this or this. RSI has been rising here. We are not anywhere close to having RSI at this point drop below 70 as it did here near this peak, or to start to fall when we're already below 70 as it did here. So based on these facts, right now, given the data that's in front of us, the present day really doesn't look anything like this period here, and it really doesn't look anything like this period here. Obviously, that's subject to change, but we make decisions based on the facts that are in front of us today. And the facts that we have in front of us today look like this. All right, let's assume that you're not a big fan of indicators and you prefer to look at price. That's fair. NASDAQ quarterly, 1983 here, up to the present day, or June 21st, 2018. We have a consolidation period here. The longer a market goes sideways, in this case 27 quarters, the bigger the move that we can expect to get. In this case, we rallied for 34 quarters. What those indicators were telling us here in the year 2000, when they were all extended and at extremely high levels, was that risks were increasing. Why? We were extended from a base. This is support here. At this point, we are 34 quarters away from the major base. So in this case, at the major peak, our extended from base ratio was 34 to 27. We were 34 quarters extended from a 27 quarter base. That's 1.26. In the present day, our box, which is drawn the same way, based on this high and based on this low. So we move backwards and see what we can hit. Based on this low, we move backwards and see what we can hit. And then we take these highs here and box them up. We take these highs here and box them up. So our risk ratio at this point is 1.26. Since we have only rallied for 1, 2, 3, 4, 5, 6 quarters, instead of a 1.26 extended from base ratio at the major peak, the present day we have a 0.07 extended from base ratio. We are 6 quarters above an 82 quarter base. That's why the indicators look the way that they look in the present day. This is risky because when we're here, you can't see any of this. You're way up here and you really don't have any major support close by. That's not the case in the present day. Instead of being 34 quarters above a 27 quarter base, we are 6 quarters above an 82 quarter base. The longer a market goes sideways, the bigger the move that you can expect to get. We rallied for 34 quarters after going sideways for 27 quarters. Logic tells us it's not irrational to think that the rally from this point here could last longer than 34 quarters. We are only 6 quarters above the base, telling us to keep an open mind about better than expected outcomes. So you could be sitting at home and laughing and saying, this isn't consolidation. Well, it is consolidation. Markets are fractals, meaning the way that we treat consolidation for 27 quarters is the exact same way that we would treat consolidation for 82 quarters. The only difference is the longer you move sideways, the bigger the move you expect to get. A consolidation box for 27 hours relative to 82 hours, we would draw the same conclusion. Is there any mathematical basis to back up the claim that this sideways movement is consolidation? The answer is yes. ADX can help us out. Here's the same ADX that we looked at. This is extended here. We're extended from a base. We're not that extended relative to this here. Wilder is the last name of the creator of ADX. Wilder suggests that a strong trend is present when black ADX is above 25 and no trend is present when below 20. If no trend is present, that's the default is consolidation. We have 3 things that can happen. We can get bullish trends, consolidation, or bearish trends. When ADX drops below 20, we're basically trendless. And that's exactly what this says here. ADX down here is in the 14s. This is our sleepy, trendless market. ADX starts to rise from below both green and red. This is close to this rings a bell that a new trend is starting. This doesn't look anything like this and looks a lot more like this period here where good things happen for a long period of time. The other way that we know this is consolidation, we can draw horizontal lines and hit price several times. Horizontal line, I hit price. Horizontal line, price, price, price if I drew it here. I can't do that during a trend. This doesn't exist here. So when I'm up here and I draw horizontal lines, I'm not hitting price several years away. This is consolidation. See, I can do it here. Hit price several times. Hit price several times. And the same thing is true over the past few months. We've shown it on Twitter. If we can draw horizontal lines and hit price, that's consolidation. No trend is present when below 20, as it was here. And a strong trend is present when black ADX moves above 25. How far above 25 are we? Not that far. We're at 37. We were just hovering around 30 in 2016, and we're sitting right near 25 in early 2014. This is another way of saying we're really not that far away from our consolidation period, which was not the case looking backwards here. And just as the 82 quarters would tell us this is a better entry point than the 27 quarter entry point here, ADX says the same thing. ADX is not, black ADX is not below both green and red. If you know your ADX, the longer you go sideways with black at low levels below green and red, this is the longer your base, the bigger the move you can expect to get. This is a sleepy market, but this is a sleepier, more trendless situation here and a better entry point mathematically than this point here. And even after this, good things happen for a long period of time. This is a 650% move here over 34 quarters. And as we've noted in past videos, if we can use hard data to help us understand what volatility to ignore looks like within the context of an ongoing trend, and volatility to respect looks like when that long-term trend rolls over, allowing us potentially to mitigate some of this damage. If we look at extremes, we can understand why this is so important. In case A, if I start with $2 million here, and let's say I'm a buy and hold investor in the NASDAQ for conversation's sake. Extreme examples help illustrate concepts. And let's say I'm buy and hold NASDAQ and I get lucky. I earn 650%, my 2 million turns into 15 million. Let's say I run the same strategy here. I'm going to be buy and hold in the NASDAQ, and I'm unlucky, meaning I'm not looking at any data. I've just decided to be buy and hold. Instead of my $2 million turning into 15 million, my 2 million would have turned into 440,000, which is why we are constantly asking questions like, how does the present day compare to a major peak? Because if the present day doesn't look like a major peak, then our default should be two things. Number one, the probabilities say higher highs are most likely in the cards. And number two, if the data allows, we should try to act like a buy and hold investor. One of the biggest reasons why investors fail to capture even a large portion of a move like this, a 228% gain in the S&P 500 between 1995 into the spring of 2000, is because they have unrealistic expectations about how markets work in the real world. Red screens and red days are 100% normal and to be expected. Relatively large down days, even on average, are 100% normal and to be expected. And if we're going to try to navigate from a point A to a point B, that could be several years down the road, we have to understand in advance there are going to be periods of gut-wrenching volatility along the way. We know that with 100% certainty, which means we always have to be on guard to avoid these common missteps. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.